Having said that, I want to get this session rolling because there is a lot of fun stuff to come. Let me start by inviting for this discussion on the rise of passives in India, new regime or just a passing phase. I mean, if you look at the global environment and what passive investment also says about the state of the art of active money management, and particularly for aspiring and current quant professionals, there is both hope and alarm bells. So who better to talk about these alarm bells than Balakrishnan Ilango? Bala works as head of innovation and analytics for the APAC region for LSEG, LSE Group. He'll be joined by Vishal Jain, CEO for Zerodha Fund House. You call it Fund House? Oh yeah, it's Fund House. And Lakshmi Iyer, the delightful CEO of investment and strategy for Kotak Alternate Assets. And Amit Vashisht. Amit is the head of the ETF Business for ICICI Pru AMC. Delightful. And at some time or the other, almost everyone has been a client from my Bloomberg days, which is hilarious almost, except you, Vishal. So yeah, a couple of interesting perspectives. Bala is, again, a very enthusiastic research scholar to whom I turn for advice from time to time, starting today. Lakshmi has been a prominent voice in the space of quantitative-based asset management, and we've had some delightful conversations in the past as well. Can't wait to see what she has to share. Vishal, as part of probably one of the fastest growing forces within the financial services community, with a brand and an organization that has redefined the way the markets engage with assets as a whole. I think there's a lot for us to learn from Vishal as well. Vishal mentions that while strategies aren't new, adoption is becoming far more accessible, which I think is a paradigm shift in just the way liquidity is made available to market participants. It's a gray area that I find very fascinating. It's worth discussions. And Amit brings a lot of on-the-ground insights from launching passive products. ICICI AMC has a pretty stellar performance record with passive products. So on that note, over to you, Bala.
Thanks, Joel. Good evening, everyone. As we gather today, India passive investment story is reaching a remarkable milestone, where we have seen a phenomenal growth of more than 11,000 crore under asset under management. Behind these impressive numbers, there lies a fundamental question about the future of the capital markets. Right? I'm Bala Ilango. I'm joined by three distinguished industry veterans. And today we are not going to take any sides, but we want to understand the implication of the transformation for all the market participants. So probably I'll start with you, Lakshmi. Given the explosive growth we have seen in the passive markets, with folios growing 30+ % year on year, with phenomenal new fund launches, more than 100 funds got launched in 2024. How would you characterize these? What are we witnessing? Is it a new regime or is it just the trend?
Hi, good evening, everyone. Sorry, I've been talking non-stop since morning, and I did try to have some filter coffee here. I went to Third Wave Coffee. I was told the coffee is exceptional. I'm not a tea coffee person. I go to Starbucks also and I order green tea, but I said something warm to keep my throat good. The coffee was not so great. Sorry if there are any peas in this room, they're going to be disappointed. But so pardon my hoarse voice today. Thank you so much. This is with fag end of the day. And I would say not a superstar discussion, because the limelight or the blockbuster moments are always captured by the alpha managers. And I know that because I am still managing funds, active, passive, listed, unlisted. So Bala, you're absolutely right saying that this is not taking sides, but clearly to your pointed question, I would say that the asset management industry, the way it is being managed is actually gradually, I'm not saying completely, morphing itself from blockbuster, superstar oriented male protagonist movie types to content-driven OTT series. If I were to bring in my pictures and Bollywood, love here. I would have, I would watch any movie of Salman Khan, for example, or Amir Khan. Every Eid release, I'll go, how much ever you say, yaar, ye Bajrangi hai, ye Bhaijan hai, ye Kick hai, ye Wanted, it doesn't matter. Amitabh, I think most of us, have grown up seeing his movies. But Sarka, when you move to Netflix or Amazon Prime or Jio, what is driving you is not the star character or the star person, is actually the content. So if you understand this analogy, you'll exactly appreciate what is happening to the way funds are being managed. Circa 2015, yeah. I was in Kotak AMC, I'm now with Kotak Alternates, but at that point in time, the drawing board discussion was, do we really need passive funds? Now it is passive plus quant and all of that, and it's not just curd rice, it is curd rice spiked with whatever your favorite poison is, but it's spiked with all those condiments to say that it is a plus plus. So, less than 1,000 crore AUM or 1,200, 1,100 crore AUM in 2015, less than 30, 40 ETFs to over 600 ETFs and 100 launches just last year to 11 lakh crore AUM. That's the kind of size that we have reached. So clearly content is king. Is this a fad or a trend here to stay? There is no doubt in my mind that this is a trend which is here to stay and make its a presence felt, I would say, with a thumping uproar. As goes a rap song in Gully Boy, which says, Apna time aayega, that was the song which passives used to sing back in 2010 or 2015. And I would say that now it is clearly a platter of equals, where coexistence is clearly the Gully Boy's claim to fame.
Right. Thanks, that's a very fascinating perspective. I always, love the kind of analogy, which you sort of, give it, right? Next, over to you, Vishal. Right? Building on Lakshmi's insights, how has the passive landscape evolved from the early days of the basic Nifty ETFs to today's sophisticated smart beta products?
Sure. So, I think one of the ways to look at it is possibly split the entire journey of the last, say, 25 years of passive in the country, maybe in 3 phases, similar to what, Lakshmi's also spoken about. The first ETF was launched in 2001. And I would tend to think all the way from 2001 to about 2015 or so was quite a bit of a struggle where offtake was less, people didn't understand the products. Active was something which was gaining ground. Most distributors were all selling active products because that's where the distribution commission was. From 2015 onwards, one change that happened was that EPFO started putting in money. And that led to, the sharp spurt in AUM on the institutional side. And I think that woke up a lot of people in the market in terms of, if a large institution like an EPFO can start investing money, there must be something in the product. The third phase was, I would say, from 2018, 2019, and to an extent even COVID. There are 2 big events that, 2 important regulatory events that happened that led to their growth. I don't know if people here remember that at one point of time, most active fund managers were benchmarking their index versus the price index. Whereas you should be benchmarking versus the total returns index, which takes into account dividends as well. Now the gap between the price index and the total returns index is basically what you call as a dividend yield, right? And the dividend yield was typically about 1.25% to 1.5%, which was being shown as most funds as outperformance. It was never outperformance, it was just the dividend accrual that was there in those schemes. The second big thing that happened in 2018 was the scheme categorization that happened, where earlier what was happening is that a lot of large cap schemes call themselves large cap, but then they were investing 30-40% in mid caps and then benchmarking versus the large cap index and then showing that it is outperformance. So basically wrong benchmarking was happening for a long period in the country, right? When data started coming out from 2000, with all these changes, when data started coming out from, say, 2019 onwards, it was reflecting that very few active funds were actually underperforming their benchmarks. And that's when you saw a huge trend, especially on the index fund side. A lot of the smarter guys started moving their money towards low-cost products like index funds. So when you look at the growth, say, in passive over the last 20, 25 years, you have to compare growth, especially on the retail side. That means initially it was institutional, but the retail and HNI bit started only about 7, 8 years back. And now the traction is pretty huge. If you look at AUMs, right, we're talking about ETF AUMs at about 8.5 lakh crores or so. It's added about 1.3, 1.4 lakh crores in a year, which was the total AUMs about 5, 6 years back, right? Even in terms of number of investors, in the first 9 months of 24-25, there were about 50 lakh investors that were added, which was the total number of investors all the way in the first 2 decades of passive, of ETFs. So that's the kind of growth we're witnessing now in terms of ETFs, and the same is also being seen in index funds where the number of investors are shooting up like crazy. I mean, last year itself, there was something like 50, 60 lakh new folios that were added on the index fund side.
Thanks, Vishal, for sharing your evolution. You described as remarkable. Now let's look at the institutional angle, right? Amit, to you. What role has institutional allocations, particularly from EPFO, played in this growth trajectory?
Sure. Am I audible? Yeah. So Vishal has already covered about EPFO. To start with, before I talk about ETF, if you see the financial journey, even if you talk about mutual fund, 20 years back, any financial assets is basically first picked up by institutional player. And then you see ultra HNI, family officer coming into it, and finally retail participate. Same way what we have seen since 2016 when EPFO started investing into it. People start seeing this as a serious category. They thought if EPFO thinks this is a big thing, let us also explore. And what we have seen post-2020 again, now post-2020, a lot of smart beta products come into picture. Ultra HNI family offices have started investing into this as a category. And with the digitization, what we have seen, fintechs have come in, the buying of stocks is so easy, so many DMATs are coming up. So the opportunity for ETFs are much bigger than compared to a mutual fund is what I feel. Definitely EPFO helped, brought more confidence, but now is the time to retail to pick this as a category.
Right. Thanks, Amit. Again, over to you. Before we explore innovation, right? Let's establish the analytical foundation. When each of you decide to launch a new smart beta product, what quantitative approach you use it? If you can walk us through the analytical process from factor identification to backtesting methodology, how do you ensure you're capturing the genuine risk premium and not just the data mining?
Sure. So not only talk about smart beta, our first criteria to launch any passive product, what we have seen, we are still in a nascent stage. We need a lot to pick up in terms of liquidity. So that's our first criteria. If we launch any category, whether it's smart beta, whether it's a market cap product, our first criteria is will be able to offer the liquidity. That's a major mandate. Will be able to maintain the good tracking error. These two are the first criteria. Third, our internal criteria is if this category makes sense to the client. There are a lot of buzz you might have seen in last 1 year, a lot of products on defense side and other categories who are picking up. But we do filtration criteria in that as a space as well. Will end customer get a better experience while launching this as a category? So these 2-3 things we keep our mind when we launch passive products, whether it's smart beta, whether it's sectoral fund, or whether it's a market cap product.
Great. Your perspective, Lakshmi?
So, one needs to first identify where is the gap. And let me take the example of thematic or sector-based ETFs. We all know that if you look at Nifty, which is the representation of the large cap in the country, or Sensex as the case may be, specifically to Nifty, we have almost 35% of the index which is hogged or represented by the BFSI or the Banking and Financial Services Index. So if you own the Nifty, which is a proxy of the country or proxy of the large cap in the country, the top 50 stocks, de facto more than 1/3 of ownership is in BFSI space. Now, what happens if you have to look at cyclicality? when you are looking at cyclicality, for example, last 18 months, pharma sector or healthcare sector has had a very, very fantastic dream run. What percentage of Nifty was it 18 months back? Under 3%. Today it's at 3.2, 3.3%. So if you buy Nifty, out of $100, you're just getting $3 of pharma. So I think that is one of the important criteria. Second criteria on the quant part, when you try to modify a particular index, there are multiple factors which you have to take into consideration, just not the price and the earnings, because there are certain factors which actually drive the momentum and otherwise, like Vishal alluded to the dividend part of it, which is the quality aspect of it. So I think like this, there are a list of criteria, so theme being one of the criteria, the factors which are influencing the price of a stock as criteria. Macro is just one bit. HFT or high frequency traders, I think most of you are present in this room don't need an introduction to that, clearly tells you that every nanosecond there is something which is happening in the market in terms of a trade being bought or sold. So, how do you identify some of these factors? And which is why if you see the indices, the index providers, they are refining their rebalancing period also with respect to these indices. So I think innovation is going to be the bedrock of how the next 10 years of the passive investments is going to look like. And within that, I'd say the overlay of quant. So it's going to be more like a quantamental approach. Quant being first and fundamental being next is going to be a very, very massive driver because clearly human beings are getting outperformed, and how? Of course, we can, layer it saying that it is more specifically in large caps, to a lesser extent in mid markets and small caps because of the liquidity. But nevertheless, I think it's a matter of time that you are going to see those trends changing, and it's literally high time that we all smell the coffee.
All right, thanks. That's a great perspective, Lakshmi. Over to you, Vishal.
Yeah. See, we don't have any smart beta product in that sense, but maybe what I can add to the conversation is in terms of where it can fit in a person's portfolio. I think it's always good to split your portfolio in a kind of core and satellite kind of an approach, where the core, which is the main part of your portfolio, is backed by a low-cost index fund because your objective is to get exposure to the Indian market. The satellite part of the portion can be a smart beta product, right? We have to understand that smart beta products are technically not passive because the underlying as Lakshmi said, is quant at the end of the day. So it's not passive. When it's not passive, it is active. That's the way to look at it. Therefore, when you look at different factors, whether it may be momentum, value, volatility, or whatever it may be, different factors do well at different points of time, right? And therefore, picking and choosing the right factor which will help the core part of your portfolio is something that you still need to pick. It's like going and picking an active stock. So you need to kind of sit there and understand in terms of what is that particular factor that is making sense to you and the portfolio at that point of time. I don't know who coined the word smart beta, but and I don't know how smart it is, but if you looked at history of smart beta products, they kind of started off in the US. And if you looked at the most popular smart beta product, which was there in the US, they were all dividend yield strategies, right? And it was dividend yield strategies simply because of the fact that interest rates were very low internationally, especially in the US. And that's why those strategies kind of, became popular, right? Over a period of time, people started using quant and, kind of segregating different factors from the price of a stock, looking at it statistically. Right, and therefore that's how you came with value, that's how you came with momentum, that's how you came with all these things. Now if you see what is popular, everyone talks about the fact that, look, you should not do a single factor, but you should look at multi-factors, which in my opinion the stock always was. It was that some smart guy just went and started splitting it in different factors. So all I'm trying to say is that smart beta products, you should look at it. Just ensure that you're understanding which factor you're looking at. And that it should be part of the portfolio to kind of complement the larger part of your portfolio.
Okay, great. Thanks for the perspective. Another question for all of you is like when we compare the innovation in passive products globally versus India, right? So what gaps do you see? And why haven't we seen the same level of innovation that transformed the market in US?
So, if you probably, if we would have had this discussion maybe, Bala, 5 or 7 years back, you never had a momentum ETF. You never had a momentum mid-cap ETF, for example. You never had a defense ETF. So I'd say that, and a lot of these things are already there in the Western world, specifically in the US. What we don't have right now, I'd say in India, and that is where, as I said, I started off saying that identification of a gap, plugging that gap and making it available, I think that is very critical. Some of them could be a no-tread kind of a territory, but I'll still mention about that. Crypto, for example, it may take its forever time, but talking about blockchain, I think that is something which India is also aping, and India is using that pretty vehemently. So I think something which is on the alternate asset side is something which is completely lacking in India. Commodities, we have just gold and silver right now. We do not have a third, obviously because of storage and liquidity, all of that. But again, outside of India, specifically the US, we have all sorts of ETFs, including crude oil, which India is one of the largest importers. So we understand there are Indian companies which are price takers, apart from just the country which imports. So I think in commodities, I think there is still some more elbow room for us to be able to get more creative. Leveraged ETFs. If options and futures is being used not just by institutions, but by the evolved HNI, MNI fraternity and the retailer who understands this. See, it's ultimately a discipline game when you are doing futures, options. What is stopping India from having leveraged ETFs or inverse ETFs which are uncorrelated or give returns contra to what the market is behaving? So I think these are some of the plug plays that are required. We had last week, a set of institutional investors who were at our office, and genomics, robotics, artificial intelligence. One might call it a fad, one might call it a trend. I don't want to really give verdicts on that because I'm not the most qualified to talk about it. But clearly today, Google is losing its market share as far as search is concerned. ChatGPT is definitely, ruling roost. So I think if that were to be the trend, see, some of these commonsensical trends is what one needs to identify and create a use case around it. Is all of that possible in India? Possibly not, because there are no underlyings for it to be made available. But through feeders, can that be made available? Possibly the answer is yes. So I think working around some of those, trying to identify dev tech is a big thing. Space tech is a big thing. Very, very basic grassrooted things. So, if you see the new breed of entrepreneurs, and I have a couple of my own colleagues or ex-colleagues who have now started to do something on their own, very small scale, okay, will never come into mainframe. But the kind of businesses that they are doing is modified fintech space. Very basic thing like an NBFC collection mechanism. You could call it very commonsensical stuff. But I think these are the incremental gaps which clearly need to be plugged. Till about a year back, did we have a railway-based ETF? Answer is no. Today we have that. Is it size to scale? Answer is no. But I'm saying that these are some of the plug and plays which clearly Indian managers are looking to harness. And well, who knows that this 100 ETF trend could well be 1,000 ETF, and it's a matter of time.
Yeah, that's a great insight you gave, right? And especially the levered and the inverse ETFs. To add on to that, the wall ETF, right? Had wall ETF been there, it would have been significantly easy for the retail investors rather than understanding the underlying math of the derivatives.
No, absolutely. In fact, investors have been asking us, can we trade India VIX, and is there a fund which we can participate? Well, the unfortunate answer as we speak right now is no. But then again, globally, all these things have evolved. We are at a phase or stage, and if you look at the growth of the ETFs, as Vishal rightly pointed out, 2001 to 2015, it was like this. And then you had a hockey phase or a hockey stick kind of growth, obviously with the advent of institutional investors like EPFOs. Well, they may still stick to mainstream, but for every Dharma production and Sanjay Leela Bansali, we need to have a Shujit Sarkar and Anurag Kashyap. So these could be your Shujit Sarkar and Anurag Kashyap. I don't mean to say that one is better than the other, but it is, as I said, a classic case of coexistence.
All right, thanks, Lakshmi, on that. Now let's move to the regulatory framework. Over to you, Amit. SEBI introduced the mutual fund, meaning MF Light framework in December 2024. Specifically for passive funds, right? How transformative is this for the industry? Will this accelerate this shift, what we're seeing now?
We are actually, it's a pivotal, what I feel for passive as a category. This MF Lite not only happening to help the new age companies, you talk about the old age AMCs who are doing to active now have a easiness to launch these products. The compliance is not that strong. You can launch a product within 10 days, which was used to be more than 2 months. The operational costs have come down. So these parameters are going to help to these products. Anyways, these products are low cost products. So the cost burden, if we are reducing on the operational side, we are reducing on the compliance side, will definitely help these products to run on a lower cost. And with this FM Lite model, we have seen a lot of new age fintech companies can launch a dedicated space if they want to be into passive. So if new age companies are coming to a passive with more competition, we have seen wherever more competition comes, more evolution comes, more clients comes, and it's good for the product and good for the end customer. So definitely this MF Lite going to help passive industry big time.
Okay, great. Thanks for your perspective. Vishal, over to you. From this, do you see this as a level playing field, for the smaller and the new players who are getting into this space?
I mean, yes and no. If you look at the regulation, so when you look at it from a perspective of the fact that the regulatory burden has come down, yes. I mean, even within the organization, I mean, keeping in mind that we do only passive products at this point of time, definitely the regulatory burden has come down, right? And even the cost has come down because various things like, the investor education fee, etc., is all become half as compared to what it was. Even the number of board meetings, etc., that you need to have has all come down. So in terms of burden over there is definitely come down, and and you're able to focus a lot then on business. In terms of whether it'll get more and more fintechs to come in, I mean, I don't know. I mean, if you look at one of the drawbacks also of MF Lite is that it just allows you to do a couple of indices. Because there's a criteria in the regulation which says that for you to launch a product on any index, it has to be tracked to the extent of minimum to the extent of 5,000 crores. Now, when you look at that, there are very few indices in the market that actually qualify for launch in MF Lite in that sense. And therefore, I'm not too sure whether that can be a showstopper for people to come in, because if you have an entity which kind of comes into the market and is coming into a market which is already crowded and it's got so many people, 45 AMCs with nearly 11 lakh crores floating in passive products, and you tell the fintech that, look, you can only do a Nifty 50, you can only do a Nifty 100. You're asking him to get into a battleground and just fight with the biggies over there. I don't know to what extent they'll be able to penetrate, just keeping in mind that they're not able to innovate on the product side. And therefore, all that is left is innovation then on the distribution side. So I'm not too sure whether there will be a lot of fintechs who actually take that bait because of this limitation on the product side.
Yeah, great perspective, Vishal, on that. Over to you, Lakshmi. Let me start with you on the active-passive coexistence. Rather than viewing as active versus passive debate, right? I want to, how would investors think about these as a complementary tools? What's the optimal allocation framework, for different investor types?
This has been a forever debate. So I've been an active manager and I've launched passive products. So I can wear both the hats and give you a perspective that one should not treat them as competitive. One should actually look at them as complementing strategies. And I'll elaborate why. At any point in time, any established AMC in India is serviced by at least 40 sell-side brokers. Okay. Now, in that, the stocks under coverage probably will cut off at 250, 300, dhakka marke 300, nothing beyond that. But if you look at the total stocks which are available, listed is 10 times that, 15 times that. So what happens to those under-researched stocks, those stocks which are probably not under anyone's coverage, where you are doing your own fundamental research, don't really have that kind of wherewithal? Those kind of areas, and they are largely in the mid category, small and mid cap category, there is reasonably high scope, I would say small cap and mid cap in that order, for alpha generation or excess return generation over the benchmark. Again, their quant funds are coming in where they're identifying those opportunities slightly ahead of the street, but nevertheless. When you go to the large cap space, which is a well-researched top 100 stocks, in the universe or of the listed stocks, you realize that incrementally generating that additional return is not impossible, but it is getting challenging. The number varies, okay? If you cut off a particular data point, so if you see 2024, almost 70% of the large cap managers underperformed. If you would have seen the year before that, the number would have been 50-50. In US, it is very consistently underperforming. So US is a way more mature market. So there they'll say that, yeah, large cap ke beyond, there is absolutely no reason to be in large cap. You should be only in passives. See, our case is slightly different. So I would say that we are in a cusp kind of a stage, neither Nar nor Mada. We are the Ardhanarishwar kind of a situation where we saying that coexistence is going to be the word. And I'll bring in smart beta once again here. For example, even in the large cap space, we have done running, rolling, tumbling analysis, whatever you call it, over the last 15, 17 years to give reasonable comfort and confidence to ourselves that a combination, for example, and we did multiple iterations across categories to see a combination of a low volatility index plus a momentum index. If you pair that two in 50-50, you don't need to get too adventurous there, and compare that with a large cap index, for example, it has on an average generated a 3% CAGR outperformance. And this is just the large cap space, okay, top 100. So I think incremental anecdotal evidence is pointing towards the fact. So imagine if a large cap manager is underperforming a Nifty, he or she will have to walk that extra mile to be able to outperform a large cap momentum combination. So I think, but if the same thing you chisel down into the lower market cap companies, that delta is still very high, the barriers are still very high. So only two ways to do. Imagine the lowest ETF in the country today is at what, 2 basis points? Even a liquid fund would be at least 7 times more expensive than that. So I think at 2 basis point, if you're getting the world of 50 stocks, I mean, why would you second guess that? So I'd say that is the way to approach your investment portfolio. And if you want to do cute and exotic stuffs, you do that in the unlisted space. There you pay more and you get more. You lose more also, no two ways about it. But it takes two to tango. So I think it's a dual-edged sword. But in plain Jane investments, I think it's a combination approach or the hybrid model in auto, as they say. I think it's the hybrid model in investments, which I think is going to be the way forward.
Thanks, Lakshmi. How do you see, Amit? You run ETF, but at the same time, ICICI Pru as a large entity, you have both active and passive. How do you see it?
So my day starts with the same thing. Wherever I go and meet, the question is, who are the active players? We have been all active in equity, hybrid, a lot of categories are there. So we again say, obviously it's a complementary, but it's a competitive. Competitive is within active also. Hybrid compete with large cap compete with small cap. Some will sell small cap, some will sell large cap. But I feel till the time active fund managers are generating alpha, they can command that. Same way between smart beta and market cap product. If smart beta can outperform market cap product, they can also command higher expense and can run that as a business. So I personally feel till the time that alpha is there, they will enjoy that journey. But still, what Vishal highlighted, Nifty, I still feel is the first product to be a part of anyone's portfolio. If you want to add financial literacy in India, the easiest thing to explain anyone is Nifty. If I try to explain blue chip category to any fund house, it takes some time. Explain Nifty so is what they highlighted. So I think every category, every product will exist in India. India is a huge market, and for the passive, there's way to go. We still have to see, might be hybrid ETFs come up at some time. So a lot of innovations are pending on that side. But rightly said, what trend we have seen on the large cap space, yes, because of that rule change in 2018 with limitation on the criteria, how to filter out stocks on large cap with 45 MCs coming into picture to generate alpha to stay in the top quartile is very tough. So people we have seen are moving more trend towards large cap compared to mid and small cap as of now. But flow you see, it is coming across all categories. So I think till the time alpha is there, they'll enjoy that category. And eventually, we see that this will grow from 2% 10 years back. Now we are 15% of the total assets, which is a big number. And might be in next 10 years, it can be 35 to 40% as well.
Right. Thanks.
Sorry, Bala, one point I missed mentioning is that if you look at the mutual fund data consistently, the fastest moving category is not the large cap category.
Right.
So I think that also gives you, some sort of a thought where I don't want to say the smart money, but I would say informed money, retail money, because it's all gravitating towards a particular category. So that's, and in that same pace, in that same period, you've seen a tectonic rise in passives, which are predominantly large cap. So I think some of these anecdotal evidences is something which we all definitely must take note of.
Okay, that brings me to the next question, right? Just follow on question on that. Is it because of the small cap anomaly and people are ready to pay that size premium? Is that the reason a lot of money is flowing to small cap and mid cap?
See, I'll tell you today. I know this is not the forum for discussing valuations. Clearly, between large cap and mid cap, small cap, mid caps are small caps. I would say are still very frothy, whereas large caps. Are not suffocating, it is still bearable, so you can still survive without oxygen cylinder. So I think what is happening is sometimes there is a lot of fad and rear view mirror driving which happens in small cap. People see 100% return, they will put in their money and then see that it's 30% lower in that particular year. So I think one needs to probably cut the noise there and probably cut the fad out of that investments. Having said that, but the money is still moving into that category. It is a force to reckon with, and I'm not talking about the next 5 quarters. If you talk about the next 5-10 years, between a small cap index or a mid cap index versus a large cap index, ultimately a large cap index will deliver India's nominal GDP growth, give or take a few basis points. But it is that aspiring mid cap that actually tends to become ultimately an Ayushman Khurrana will aspire to be the Amitabh Bachchan, the next Amitabh Bachchan, right? Not all of them get that status. So I think that is where the journey of the small cap, mid cap investment is going. And there we believe a significant alpha generation opportunity is still there. And that is why, mind you, some of the AIFs in that space also have a carry structure or profit sharing structure, which probably you can't envisage in a pure, large cap based investment.
Right. Thanks. Vishal, we would love to, hear from you, because, you're focusing more on, the passive side of it. Just wanted to hear your perspective on active versus passive.
Again, agree with, what, Amit and Lakshmi are saying. It's a complementary strategy. I think in the whole quest of investing money, I think what happens is that we forget the main objective of why we're investing in the equity market. To me, there are 2 main reasons why you invest in the equity market. One is that you want to sit on the India growth story, right? And you want to beat inflation, right? There are very 2 simple reasons that I can think of, right? And therefore, I think that you can achieve with a plain vanilla, maybe like a Nifty 500 or a 250 or a 100 or whatever you're comfortable with, because there you're covering most of the country at that point of time, right? And therefore you're taking exposure to the India growth story. Now, obviously, at some point of time, you also believe that there would be avenues through which you can outperform, right? Maybe you can outperform. So the best way to do is to split your portfolio, as I mentioned earlier, in a core and satellite kind of an approach, where the core is something which should be where you should take exposure to the Indian equity markets, through a diversified passive fund. And simply because of the fact that, look, if I'm thirsty, I don't need to always reach out for a Coke, right? I can, even water just helps, right? And that is what, to me, is a plain vanilla, index fund or an ETF. And that's where you should take your exposure to. The satellite, portion of your portfolio is something that you can look at alternative strategies, whether it's an active strategy, whether it may be alternative asset classes. And that's the bit that you should kind of play around with. and ensure and the portion, and that portion depends on the amount of your risk-taking ability. So should it be a 50-50, should it be a 75-25? I think it just depends on where you are as an individual. As Amit also mentioned that, look, if you're a new investor, better to introduce a plain vanilla passive strategy to that person. And once that person starts building a nest egg and is able to take more risk, then then you can kind of graduate that person's portfolio to a 90-10, to an 80-20, until a time that you believe you have enough of corpus to be then play around with. So I think that's the way that somebody can possibly look at it.
Okay, great. Today we stand at, today passive funds putting together, right, it is contributing to overall 13% of the AUM in the industry, right? By 2030, where do you see, Vishal?
I mean, difficult to give a number, but I mean, I would tend to think, look, as a country and as an industry, at this point of time, if you look at penetration is still very limited. We're talking about 5.3, 5.4 crore folios in the mutual fund industry, which is still about 3% of the Indian population. I mean, we have to figure out how we can get, say, the next 50 crore guys coming into mutual fund products. And I think that's important. To me, when I think about it, the easiest thing for you to go and talk to somebody, like assume that, you want your house help to start investing, in a mutual fund, right? Or investing in the India grocery. The best thing for you to do is to go and tell them, look, this is an index through which you're taking exposure to the best companies in India, right? So to me, passive will help penetration happening, and passive I see is the only way that you'll be able to get the next 10, 15 crore people coming into the mutual fund industry because of its sheer simplicity, I would tend to think.
Okay, great. Lakshmi, your perspective?
Yeah, so I'd again say that the gully boy to Shehenshah transformation has already begun. The caterpillar definitely becomes the butterfly. So 15 years back, or 24 years back, when the first ETF was launched, and Vishal was part of that journey also, I would say. It was a caterpillar, the industry was a caterpillar, and now it's got reasonable wings. Is it yet there and become the butterfly? The answer is no. But I think this metamorphosis is real. If one is in a denial stage, either as a manufacturer or as an intermediary or as an investor, it's a three-way process. Then you're just fooling yourself. So I think it's high time that we take conscious note of this, something which is cost effective, something which allows you to beat the inflation which is impacting you and me, and how, and something which is so easy and effortless, and you can enter and exit faster and sooner than you can actually change your clothes. So I think that's the way I look at it.
Thanks. Amit?
I think rightly covered the flow we are seeing in last 10 years and what they both highlighted, that to quote a number is really tough, but one thing what we see compared to mutual fund PAN, if you see demat accounts, they are almost 2 times. And most of ETF clients we see are the clients who are on the stock side. So there is a high chance that we can add new clients in the mutual fund industry through ETFs. So there's a huge opportunity. I'm not sure how big the amount will be, but definitely new client acquisition, ETF will be the biggest tool in the next 5 to 6 years.
Great. Thanks. These perspectives are beautifully setting up to our final thoughts. Anyway, as thought leaders, right? I'll start with you, Amit. As thought leaders in this space, what specific work or initiatives would you like to see from Lakshya as an industry association to advance passive investing in India?
I think there's a great initiative that started talking about passive specifically on Quant platform, and somehow we have seen now everywhere those who talk about mutual fund are bringing more on the passive side. We are expecting the way you pitching Quant, if we can work it on some models which you can also highlight, be helpful to launch in the passive as a space. And we bring this Lakshya not only to Bengaluru, but we do these events across India, will definitely help us to reach out to the last customer.
Great. Lakshmi?
I would say the biggest raw material for a strategy like Quant to succeed is actually the talent. And I find the talent pool hugely lacking in India, significantly. So I think I would definitely request Laksa to be able to create that talent pool for people like us to hire for sure.
Great.
No, so I think quant is very natural to passive in that sense, because in a sense passive products are also quant. So I mean, talking more about it, and even if you look at the way hedge funds and all that work internationally, they use a lot of quant strategies, and they use a lot of passive products to execute their strategies. So I think this is a very good initiative, and I think talking more about it is something which, as we progress, as Lakshmi said, that we need to build a good talent pool, and this will definitely help build that good talent pool. Yeah.
Right. Thanks. That's a great input for Laksha as well. We'll definitely take a note of it, and I think we're well on time. I guess thank you very much for sharing your insights and perspectives.
Thanks,
Thank
thanks,
you.
Bala. Thanks, Lakshmi.